government spending creates money, creates free money for the private sector. And this has been empirically replicated by post-Keynesian economist Wim Godley in his sectoral balances model, where he empirically demonstrates when the government goes into deficit, the private sector goes into surplus. Now, that statement goes against all of the kind of economic doctrine that we are taught in high school and uni, against all the conventional wisdom and understanding of economics in popular discourse and media. But let me cook. If we go back to Graziani's circuit, he understands the state to be, like any other kind of borrower, an institution which goes to a bank to access finance. But what's different about the state is that the state issues government bonds, or essentially IOUs handed to an investor with the promise of being paid back. And they're usually incredibly stable because the government is a guaranteed institution if it's sovereign, right? So the government, with these government bonds, sells them to the Reserve Bank, and the Reserve Bank, like any other bank, creates money to buy these bonds. It then gives that money to the government. The government then spends that money in the economy. So like in the private market, the government creates money and then taxes it later. Just like banks loan first and then put down deposits later, governments spend first and then tax later. Money is created through spending and then destroyed through taxation. Now, the reason why that's free money to the private sector is because, again, if we understand money creation to be endogenous to the economy, if you're increasing the supply of money through government spending, that means that there is more money floating about for the private sector to access. You know, for example, let's say the government is spending money on a big infrastructure project and it brings about a large consortium of companies to facilitate that construction. All of that government money is going to the private sector in contract money, and those private companies themselves are borrowing from private banks to finance their construction. So in this equation, government money is underpinning the private finance of banks and then therefore the firms they lend out to. This is how Graziani explained the deficit explosions in the 1980s. You know, the period of neoliberal economics or whatever, state budgets were exploding in deficits, right? You know, if you look at the share of government spending to GDP, it's been a general upward trajectory since the 1970s and 1980s, despite the whole neoliberal doctrine of reducing government spending. And in that same time period, inflation has generally come down. The cost of borrowing has also generally come down. So it seems like the real economy, the actual economy, when we look at it, goes against the idea of neoclassical economics, right? The idea that there is a fixed supply of money and therefore governments and the private sector are competing for that fixed supply of money.